And now let's do some Q&A. One person was commenting on the graph for mortgage notes and how rates have changed over a 20-year period. There is definitely like a market rate interest rate that fluctuates based on what supply of capital in the market is looking like. Right now, interest rates are at historic lows. So the Federal Reserve is artificially depressing interest rates. And so rates are very low. And what that means is there's usually a delta between what someone can borrow from the bank and what the private investor market is offering. So right now, people can get money from the bank at 4 to 5%. The private investor market in first position trust deeds, is probably in the 7 to maybe 10, 11% range for notes. So if prevailing interest rates go higher, mortgage interest rates should go higher in the private market. I don't see it's realistic that interest rates would go significantly lower than where they are today. We're already at incredible lows. So that graph showing a 10% rate over 20 years, if anything, that data would be even more positive in favor of mortgage note investing, because over that 20-year period, there were times where you could have gotten 20% or more for a private mortgage, because prevailing bank rates, were in the teens. Do performing mortgage notes, so this is another good question, do performing mortgage notes provide compound interest? If not, how does the compounding come into effect if you buy a 20-year note and hold it? So when you own a mortgage note, the monthly payment is principal and interest. The principal you want to reinvest, and that's the way that you keep your yield high. And the interest, you could spend it, and then it's not compound interest, it's just profit that you spend and live on. But if you take that interest that you earn on a monthly basis, quarterly basis, annual basis, however you earn that interest, and you reinvest it into more mortgage notes, that's when it compounds. So if you just buy one note and you hold it for 20 years and you just take the money and spend it, that is not going to compound interest for you. You have to take the profit that you receive and reinvest it into either more mortgage notes or mortgage note fractions. A great question. Someone asked, does our company charge prepayment penalty for payoff too soon? Interestingly enough, we have the borrowers pay loan origination points. And so what that does is on the front end of the loan, the borrower pays some points. Some of those points are profit to our company, and we usually share a portion of those points with our investor. And because we're sharing those origination points with the investor, if you as an investor buy the mortgage note and the borrower pays you off the very next day, a common response would be, I went through it's not a lot of hassle, but I went through the effort of buying this note, doing the due diligence on this note, funding this note, and then I got paid off in one day. That was really not worth it. Aha! Except for you earned that mortgage origination fee, or a portion of that mortgage origination fee. So from an annualized ROI perspective, because we share mortgage origination points with our investors, the sooner the borrower pays you, the higher your annualized ROI would be. For example, if you earned half a point origination and then the borrower paid you off the very next day, your annualized yield would be in the hundreds of percent, because you earn that fee so quickly. You earn a half a point in one day, or 0.5% in one day. A question, can you explain the exit strategy if the borrower does not refinance? That's a great question. So the borrowers typically are amortizing the loan quickly over a 15-year period. If they don't sell and pay off the loan, because the loans do have a due on sale clause, but if the borrower doesn't refinance, you're now holding that note for income for all 15 years. But it's interesting, notes are semi-liquid. So even if you don't want to hold that note 15 years, let's say you buy that note and 4 or 5 years later, your life changes or the market changes and you want to exit that note, you can sell your note or you can sell your note fraction. Our company would love to earn your business. You call me or email me, David at Hassle-Free-Cashflow-Investing.com, and say, hey, I want to sell my mortgage note. We would love to resell that note for you. That's our core business. So mortgage notes are liquid. You can buy them and you can sell them. Of course, there's transaction fees. So you don't want to necessarily buy a note and immediately resell it, because of the transaction fees involved. You would probably lose money by buying and immediately reselling. But if you buy and you hold the note for at least 6 months, you're probably going to come out ahead on your transaction fees and be profitable at 6 months. So the strategy for this, number one, plan to hold it for income. Number two, the borrower could refinance or sell the property and pay you off. Number three, you could also resell that mortgage note to another investor on your own, or our company can act as the broker and resell that mortgage note fraction for you. Another question, if the borrower defaults in a private loan, resulting in a foreclosure, does this get recorded on their credit report? This is a great question for Amy. Amy, are you still with us? So Amy might have dropped off the call. I know she had another appointment to get to. So
I'm here.
Okay, great. Amy, can you answer that question? If it goes to foreclosure, your company report the foreclosure to credit?
Yes, we do. We report it to their credit. We report to Equifax, positive and negative credit is who we report to.
Is that reporting a good carrot and stick to motivate that borrower to pay?
Usually it is, especially if you tell them if it exceeds 30 days, it's a ding on their credit.
Mm-hmm.
It's a positive to help them establish their credit, to have better credit if they want to go on refinance, and it's also a motivational point to ensure that our payments are coming in a timely manner.
Yeah, that's awesome. So if I were to originate a loan and service the loan myself, I'm not set up with the credit bureaus. And so no, if I were to foreclose on that privately serviced loan, it would not report on credit. Because we work with Amy's company, August REI, August REI is set up with the credit bureau, and therefore she has the right to report that delinquency and that foreclosure on the credit. Great question. Is there any way to avoid income taxes for mortgages held in taxable accounts? This is a great question. I am not a CPA, and so we did have a great webinar on tax strategies for mortgage note investors. In short, there are very few tax strategies for avoiding income taxes on mortgage held in taxable accounts. There are some, but I would consult with your CPA on that. The best way that I know is using your retirement account, using your IRA to fund mortgage notes. So mortgage interest or any kind of interest is not very tax friendly, which is why a lot of investors like owning real property, is because real property taxation is a little bit more friendly. But the one great thing about interest income is that you usually do not pay self-employment tax on that money. So it's taxed as ordinary income, but you're not paying Social Security, Medicare, disability. Those self-employment taxes are not applied to your income. Great question. Someone asked, do we require a licensed appraisal to validate market value? No, we do not. And so with our company, we work with a broker price opinion on each mortgage note that we sell. The way that I look at value of a property, number one, I like looking at it from an income approach, meaning if the property would rent for $1,000 a month, most real estate investors would pay about $100,000 for that single family home. It's that 100 to 1 ratio. And so that is one way for us to value a property, is that income approach. So that's definitely key for us in determining value. It's easier to determine rents oftentimes than physical value or purchase value of a property. The other approach that we use is replacement value. Almost without exception, all of the properties that are secured by our loans, the valuation is lower than the cost to build. And so they're trading below replacement costs. That's another strength for determining value. The third way, and the most common way to determine value, is the comparative sales method. So you look at that particular subject property. What did similar properties sell for that were in a similar condition? And that's what the broker price opinion letter does, is it creates comparable sales in the neighborhood to say, would this property sell for? What would this property sell for if you were to put it on the market relative to what other properties have sold for in the recent past? The fourth form of value, and I think this is the most significant, is what did the borrower pay for the property? And so if there were a willing seller unrelated to a willing buyer and there was no duress in the transaction, what did that buyer pay for the property? And that is, in my opinion, the strongest indication of market value, because there's a smart family who's putting their personal signature on the debt, they're putting their life savings as a down payment, and they've said, we think this property is worth what we put on the purchase contract. The point of the other valuation methods that I talked about, income approach, comparative sales method, and replacement cost, those other three methods are there, in my opinion, just to make sure that that borrower wasn't crazy, that there wasn't a one-off, right? So I'm going to every transaction with the assumption that whatever a free market buyer and seller entered into for a contract price, that is the value, unless one of those or more than one of those other valuation methods says, no, that borrower was just crazy. No one else would ever do that. They were a one-of-a-kind thing. The other thing with appraisals are very subjective, number one, and it is a look back in time based on one appraiser's set of data. And the subjective part of appraising is what data set is the appraiser going to choose. I own a home building company, and our home building company might sell the same floor plan, 4 times in the same month with 4 different appraisers, and that same brand new single family home on the same street, same floor plan with 4 different appraisers is going to have 4 different values. And so I always look at appraisals with a grain of salt. One thing that we do to help substantiate value for our loans, number one, we try to put as many pictures, current pictures, and if possible, a video tour of each property. So you as the investor can kind of do a virtual tour of the inside of the property and say, yeah, okay, I get a feel for the condition of the property. Number two, most commonly, we have a general contractor walk through the property, and they test the major systems of the home, specifically roof, heating and air conditioning, and foundation, and electric and plumbing. And so they're just checking those major systems to say, yes, the home is habitable, and no, we don't see any major deferred maintenance. Are they going to, comment on the carpet or the color of the walls? No, they're not. But that a general contractor is there to say, yes, this home is livable and there's no major deferred maintenance on the property. So that's how we come to evaluation. Photographs, video, that general contractors, very high level inspection, and then the other evaluation methods that we talked about. Someone asked a question. I have a traditional IRA, wife has a Roth IRA with our banks. If we were to self-direct, do we transfer to have one self-directed IRA or 2 different accounts? And the general thing is IRA, individual retirement account. IRA, so it's an individual, and so IRAs follow you as an individual, not as a married couple. And so yes, you would have 2 different accounts. However, your 2 different accounts could co-invest to buy one mortgage note. So let's say you've got $50,000 and your spouse has $50,000, and together you want to go buy a $100,000 mortgage note as 50-50 partners. That is not a problem. One of the caveats is that you buy that 50-50 interest at the same time, because if let's say your wife owned 50% and you owned nothing, and then you came in later to buy that 50% after the fact of the same note, that might have some self-dealing issues. But as long as you're closing simultaneously on that same note, you should be fine. Someone said, this is great and eye-opening information. They never considered leaving their employer being more beneficial because of the yield available on outside investments. Well, the person who wrote that comment, I wish you much success, and it is very, very true. If you make a hard money loan using your self-directed IRA and the lender defaults, making you the owner of the property, since there will be monthly obligations, insurance, property taxes, repairs, how do you fund those additional expenses if you don't have any additional funds in your IRA? That is a great question. So the first thing, and Amy, if you can get ready to help assist me with this particular question, the first thing is when you buy a mortgage note, those insurance taxes portion, the borrower is, number one, prepaid them at closing, and number two, they've been paying into an impound account. So Amy, when someone forecloses on a property and you're still holding impound funds for the benefit of that investor, what happens to those impound funds? Can you apply them to future taxes and insurance? Do they go to the lender? Do they go back to the borrower? What happens to those impound funds that are left
They
over?
don't go back to the they do not go back to the borrower. We're holding them for future taxes and insurance. The insurance is always paid in advance, and taxes are paid end of the year or January for the past year. If the property is rehabbed and resold, those transfer to the new account. If it's being closed, it's sent to the lender, whether it be his self-directed IRA or to him directly or her.
Yeah, so here's what I would do, because I own a lot of mortgage notes in my IRA. So this is my plan. Number one, I've got a portfolio of notes that are producing income for me on a monthly basis. If the chances of them all going bad at the same time is astronomically low. So let's say I had one note in my portfolio go bad. I've got other notes that are producing income. That income would go to my self-directed IRA account. I could fund the expenses for foreclosure, taxes, etc., repairs out of the income from the other notes that are performing. The other thing that you could do is, if you do foreclose, now your IRA owns a free and clear home. You own it free and clear. And so you could very easily get a small loan on that property to help you cover those costs, meaning your IRA could borrow the money. Yes, there are some tax consequences with borrowed money, and that's beyond the scope of this presentation. Just let you know that if your IRA does borrow money secured by that house, there's some additional tax consequences to talk about, but it's a possibility, right? If you find yourself in that situation where your IRA is foreclosed on a house, you don't have sufficient liquidity in your IRA, one solution is to make a contribution. The second is to use other performing assets to pay for your foreclosed asset. The third is you take a loan, and our company would be happy to talk to you about providing that loan as a non-recourse loan to your IRA to allow you to do through that foreclosure. The other thing is just, you can pay the insurance, which is important. The property taxes, you don't have to necessarily pay in that short time period when you're held the property. You just defer those until close of escrow when you resell it. And you might even find a general contractor to do all the work and get paid at closing when you flip the house. So you might not even have to come up with as much money out of your account as you think. Someone asked, where can you see a replay of this webinar? I love that comment. Where we did make a video recording of this event. It's going to be published on my website, Hassle-Free-Cashflow-Investing.com. And if you register for today's event, I'll send you an email link to that video once it's up. Thomas, thank you so much for your kind words. I'm glad you enjoyed the webinar. Someone asked, can you sell these notes? And do we facilitate the transactions? Absolutely. So you buy the note, and let's say 4 years from now, you want to reinvest that money into something else. We'd love to help you do that. Typical servicing fees. Amy, tell us what you charge for mortgage note servicing, and who typically, on the notes that are coming from our company, who typically pays that fee?
The setup fee is paid at closing, and it's $50. And the monthly servicing fee is $35. And it's all-encompassing. It includes everything: credit reporting, collections, online access, and it is paid by the borrowers.
Yeah, that's beautiful.
95% of the time it's paid by the borrowers, and all of the notes that you put together, David, they're all paid by the borrower.
Yeah, yep. So there you go, Gary. That $35 a month, I think for what Amy does, that is an incredible bargain of a price. I think it only works because most people pay, and it's hassle-free, right? So for the non-performing notes, I'm sure Amy's not making a good dollar per hour return on the performing notes. Oh, no, sorry, on the non-performing notes. But the reality is most people pay, and she earns the fee without having to do a whole lot of time investment. And then, she earns far more than her keep when the notes stop performing. Someone asks, what other states besides Texas do I rate high to do business in my opinion? That is a very good question. If you want to lend local to where you live, if that's an important criteria for you, you might rate that higher because it's a market that you're familiar in. Because I have an unlimited amount of lending opportunities in Texas, I'm focusing 100% of my efforts in Texas. Someone asked, August REI says they don't handle all states. Does it matter that I'm in Florida and I want to buy a note from Texas? Amy, do you care where the investor lives or just where the borrower lives?
We only care where the property is. So even if the borrower lives out of state and the property is in Texas, Oklahoma, Arkansas, wherever, if we're servicing there, we only care where the physical building is. Where is the property located?
Yeah, awesome.
We have lenders that are overseas, so I mean, that part is not important to us.
Yep. John asks, do you have to be accredited? And the answer is no, you do not have to be accredited to buy a mortgage note. When we sell a mortgage note, we're going to ask you a few simple questions. Number one, can you afford to lose your investment? Number two, can you afford to live without the monthly income that you're anticipating to get from that investment? And we're looking for a qualified investor. Accredited is a term defined by the Securities and Exchange Commission that their net worth exceeds $1 million or their income exceeds a certain annual threshold, $200,000 a year or $300,000 as a married couple. We do not have to be accredited to be a lender or to buy mortgage notes, but we use a common sense of underwriting approach for our borrowers. We also use a common sense approach to doing business with our investors. We think the risk of buying a mortgage note is very low, but if this is the last 2 nickels that you have and you need this money to live on, probably we don't want to work with you as a client, or we would help you diversify in such a way that you've got your assets spread out over multiple assets and you've got sufficient reserves, et cetera. But no, you do not have to be accredited. Someone asks, is there any difference to what the crowdfunding sites are offering? They're mostly fix and flip. Yeah, so the difference between what we offer and what a lot of the crowdfunding sites offer is we want our borrowers, and number one, to be long-term, fully amortized notes, because for our investors, they want a long-term income stream. As an investor, the thing you don't want is your money to come back to you and sit idle in your account, because that's vacancy. You don't want vacancy on your money. And so by getting your money out long-term, then you reduced vacancy on your money, you've increased the return on your time. For our clients, time is one of their most precious assets. And so by making all of the investment decisions once and having that investment produce dividends for years or a decade even, their return on time is significantly high. If you're doing a fix and flip, the very nature of a fix and flip is the borrower doesn't want your money. They want to give it back to you as quick as they can. They want a hot potato. They borrow it and give it back as quick as they can. That's more transactional. You can definitely make money doing that. I don't like that because it's more hassle for the borrower. I also think it sets our lenders up to possibly make more mistakes, because if you're doing a high volume of transactions, there's more likelihood that you're going to move quickly on something, and rather than study the opportunity more carefully. So we typically don't do fix and flip loans. Also, I want the collateral to be very secure, right? 75% LTV on owner-occupied, fully habitable home. I think that is significantly better collateral than a broken house. Next question: do you not need a Social Security number in order to have a FICO score? And the answer is no, you do not need a social to have a FICO. You just need a taxpayer ID number. And they use that taxpayer ID number in the credit system. That's what creates their FICO score. Someone asks, how do fees for foreclosure get paid? The lender pays them. And so if you own it personally outside of your IRA, you write a check to the trustee, who is the attorney who's doing the foreclosure. They're usually the same. So you write the check to the foreclosure attorney, and that attorney is usually the trustee who handles the trustee sale. Texas, it's usually about $1,000 for a non-contested foreclosure. If you foreclose and you have to evict after the process of foreclosure, you might spend a couple $100s more and an extra month or two in the eviction process in addition to the foreclosure process. If you do own that note in your self-directed IRA, then absolutely the foreclosure fees must come from the self-directed IRA. Otherwise, it's an excess contribution. Are private lenders, another question, are private lenders subject to usury laws? And the answer is yes, everybody is subject to usury laws. There are some exceptions from usury, and they vary state to state, and it's a very specific legal question. So if you're looking for a legal opinion, I encourage you to check, with an attorney and realize that the answer will vary state to state. Generally, if a note is originated by a licensed real estate broker or a licensed mortgage broker, there are some exceptions to usury laws. One of the other exceptions for usury laws is business-to-business transactions. So when you lend money to a consumer, like a homeowner, an owner-occupant, those transactions are much more scrutinized by usury. And if you lend money business to business, so you're lending money to a private investor to fix and flip a home, there are more exceptions to usury laws because of that. So if you've got a state-specific question, you can ask an attorney or send me an email, and I'll help you research that answer. Someone says, for a given dollar amount to invest in these notes, do you have a recommendation for how to allocate the funds? Example, small number of large notes versus more smaller notes. So that is a great question. We do have a minimum property size, but we don't have a minimum loan size. But for all intents and purposes, our minimum loan size or our typical loan size, I should say, is usually between $60,000 and about $100,000. So that's our typical range for notes that we work with. So if you've got $1 million and you want to go buy $10,000, $100,000 notes or an equivalent number of $60,000 notes, that's really up to you how you want to diversify your portfolio. If you've got a significantly smaller amount to invest, like you've only got 60 grand, and your choice is, do I go buy 100% of one note, or do I go buy 20% of 4 notes? Right? That is a question that we can work with you one-on-one to help you figure out that answer based on your overall macro portfolio. Apples to apples, I would rather own 100% of a note. If I only had a small amount of capital to invest, like, for example, a residual balance in an IRA, or I want to diversify over multiple notes and I don't have a lot of capital to do it, then note fractions could be better, right? So I would rather have a whole note than a note fraction, but I'd rather have a note fraction than anything that Wall Street sells, if that makes sense. And if you've got questions about note fractions and why we do note fractions and why whole notes versus note fractions, we can talk about that. Someone asks, do we include comps in the due diligence information? Absolutely. And if the comps we provide are not comprehensive enough for our investor, we'll go put together a more comprehensive market study. And some of the notes that we sell, the comps are harder to find just based on what's happening in a neighborhood, that the comps might be really easy and there's a whole bunch of great data on a particular area. Sometimes we have to look a little bit harder and farther to find comps, because in the state of Texas, it is a non-disclosure state, meaning not every real estate sale gets reported publicly. And so our data sample is smaller. What that means is Zillow usually is not a very good indicator of value in the state of Texas, because Zillow is working primarily off property tax records and MLS sales. And in the state of Texas, you're not getting very good data into property tax records and MLS sales because it's a non-disclosure state. So we've got to work a little bit harder to find comparable sales in the state of Texas. Another great question, are the borrowers required to reside in the property for the life of the loan? No. They are not. So if you're doing a conventional loan like FHA or a conventional owner-occupied loan, the loans do have an occupancy provision that say the borrower has to reside in it for a specific time or intend to reside in the property for a specific period of time. In our mortgage notes, we do not have a residency requirement. So if the borrower wants to move out and rent the property, it is absolutely a viable option. And remember, one of our origination criteria is that the mortgage, the principal, interest, taxes, and insurance are very comparable to the cost to rent. So if a borrower gets in trouble with their payment stream, one option for them is to move out, put a tenant in the property, and that tenant can cover most of that, all or most of that mortgage payment for them. That was an awesome webinar and a ton of questions. Y'all were a great audience. And if you do have other questions that we didn't get to, oh, here's one more question. Is it still better to consult with a CPA when wanting to invest with notes, even though they seem to be simpler than owning a rental? This is a great question. So CPA, Certified Public Accountant, CPA's training is doing auditing financials of publicly traded companies. That's what CPAs are trained to do. Audit the financials of publicly traded companies or privately owned companies. So people often go to their CPA who do tax preparation in addition to their work as a CPA. And a lot of people don't know who to go to for financial advice, and they don't want to go to their mutual fund salesperson. And so a lot of times the CPAs fill in that role of general financial counselor. But I generally find that most CPAs and most attorneys are very ill-equipped to provide good investing advice because they're really not trained for that particular purpose. And most of them are not investors themselves. So CPAs are great when you have an accounting question. If you're doing due diligence on, hey, should I buy this company, or let me do some tax planning, CPAs are great for that. If you say, should I make this investment, a good CPA is going to help you think through the tax repercussions of making that investment, but they're probably not well trained or equipped to give you an answer of whether that investment is a good risk reward, whether the investment is a good investment or not. So you can definitely rely on your CPA to help you think through questions, but generally, if you want to make a real estate investing decision, I would talk to a professional real estate investor counselor, but probably save your tax questions for your CPA and your investing questions for an investing strategist. Not a bad idea to talk to your CPA because they can give you some ideas, but most CPAs are not going to give you an answer that I would use to make my final decision. But that's my 2 cents. Thank you, everyone, for attending. We had a great time today. Appreciate you, everyone who hung in there to the very end. Would love to connect with each and every one of you if you've got questions or if you have a specific opportunity, even if it's not related to our company. I'd be happy to take a look and give you my 2 cents. And have a great day. I appreciate your time, and thank you very much to our co-panelists, Kaaren Hall and Amy Sayre from uDirectIRA.com and AugustREI.com.